Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlan, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the 2019 drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. Welcome back to the show, Tim.
And Jim, as always, thank you for having me.
Tim, the Fed met yesterday, no interest rate hikes. The Bank of Canada recently announcing no interest rate hike or depreciation. They stayed the same, and same thing for the European Central Bank. They're staying the same. Bank of England holding firm. But how long do we expect them to say no more drops or hikes?
Well, I think that the cuts are coming. I think the market's going to force the cuts. Hikes, I think that was well proven. When was that? In November, December of 2018? Time gets away so fast you have to think about when it was, but, the market checkmated them. It couldn't sustain the higher rates. And, this last year we saw lower rates. We've been in this little period of tranquility. I heard someone describe it. And, I think that, the market is going to force lower rates.
Now, who is pushing for lower rates? Is it because there's so much debt that it'll help people afford to pay it off, or is there some other reason for it?
Well, I mean, I think that it's just the marketplace. I think that, it's kind of like what comes first, the chicken or the egg. Everybody thinks the Fed has great control, which they do. The Fed does have control, but then they don't. It's I don't know if I can explain that. I don't know if that makes sense. It sounds like it's a contradiction of terms, and I guess it kind of is. Part of the control, or a big part of their control, what I'm trying to say, is the illusion of the control. That you can jawbone and give the market guidance, if you will, to use their words. But ultimately, the market has the last say. And I have interest rate data going back into the 40s, early 40s, and some of it further back than that. But you can line up, it's been simply a matter of looking at a spreadsheet, and what you ultimately see is that, yes, the Fed can give guidance, but ultimately the market checkmates the Fed and forces the rate hike cycle or the rate cut cycle. It's always been that way. And so, like I said, I know that sounds like a contradiction of terms, but yes, they have tremendous control. They've done a magnificent job at extending and holding this thing. But ultimately, if you'll remember in 2018, they had additional rate hikes planned, and they were talking about how strong the economy was, and they were going to continue to raise rates and so on and so forth. The market checkmated them. And remember, they turned dovish, as everybody talked about, and then we went into a rate cut cycle. I think what we're seeing now is the Fed trying to jawbone the market and say that, no more, they're giving it just enough. They're not saying they're going to cut because they want to paint the illusion that everything's okay, but we're not going to raise, so they want to paint the illusion that we're loose. They're trying to walk the line, but what I'm saying is I think the market, again, I think the rates are going to turn down and force future cuts this year.
Generation Z, the ones after the millennials, apparently they're the ones who are super in debt. They're already maxed out, and they've barely, got out the door. What does that tell us about the debt load?
Well, let's talk about that. That fits nicely with something I had planned to talk about anyway. A friend of mine sent me something he wanted me to listen to. It was David Rosenberg, and he's quite famous, economist. I respect his work a lot. And I was listening to some stuff, interesting statistic, which led me to look at some more statistics I wanted to get into with you, because it all ties in with the economy and the market and everything we've been saying anyway. Well, anyway, back to the debt. Between '02 and '07, Mr. Rosenberg points out that the global debt was up 30 trillion. Between '02 and '07, up 30 trillion. And the corresponding GDP growth was 25 trillion. So if you do the math, you had, lack of a better words, a multiplier effect of 0.83. So every dollar spent, you got, 83 cents worth of GDP growth. You fast forward to the period between 07 and the most recent data, I guess the end of 19, is probably the data he had, to current, whenever that would have been. And we see that he said that the global debt had grown 128 trillion, but we only had 27 trillion of GDP growth, which is 21%. So it's a diminishing return. We've seen it. The benefit versus the dollar spent has been, what's the word? Just a diminishing return. So the debt level is producing, it's taking greater and greater debt. I'm stumbling for my words. Greater and greater debt to produce $1 of GDP. So that led me to look at some of the numbers in the Fed, and what I found there was pretty interesting. Between '02 and '07, I looked at the same periods he quoted. Between '02 and '07, we saw an increase in the federal debt of 3.3 trillion, and we got $4 trillion worth of GDP. So if you do the math there, the little multiplier effect on that would be 1.21. So for every dollar of debt, we got $1.21 of GDP. So I'd say that's productive debt. And again, that was between '02 and '07. But you fast forward to now, between '09 and the latest numbers that's available, we had $11.9 trillion worth of debt versus $7.2 trillion worth of GDP growth. So that's a factor of 0.6. So that's 50% of what it was, 50% less effective multiplier effect, if you will, than what was seen between '02 and '07. So again, those numbers confirm what he was saying, that we're seeing it's taking more and more debt to produce $1 of GDP, which I would say is unproductive debt.
We'll have more with Tim Cyclesman Wood right after the break.
Cypress Development Corp. is developing a world-class lithium resource in the heart of Clayton Valley, Nevada. The size of the resource makes the Clayton Valley project a premier asset with the potential to impact the future of lithium supply. Cypress Development Corp. trades on the TSX Venture Exchange, symbol CYP, the OTCQB, symbol CYDVF, and on Frankfurt, symbol C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Media recognition from Bloomberg, Reuters, Recycling Trade Publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Tim Cyclesman Wood. Tim, if things are so great with the U.S. economy, why do they have to lower interest rates?
Well, that's the point. I mean, if things are so great, why are things so bad? If all of this stimulus and QE has worked, then why are these numbers like they are? Why are we seeing an increased or diminishing return for the increased debt? If everything is so good, why are the economic numbers that I went over last time, and I can hit those again if you want, with the employment growth rate and the GDP growth rate and all that kind of stuff, why is it contracting? Why is the yield curve so flat? Why is the CRB index been so weak? Why is the industrial metals weak? In fact, the industrial metals index is back to '09 levels. And so why? Why is the 2 and the 5 year trying to invert? Why is there? I mean, I could go on and on and on. Why is the 3 and the 5 year inverted? If the money printing and stimulus is so inflationary, why hasn't it re-stimulated the economy? Why is it that the velocity of money is turning back down? Why is it that the Baltic Dry Index has collapsed and is below its 2019 3-year cycle low? Why is it, I could go on and on and on and on. And so what we have is this, like I've said, and it's gone on, it's insane at this point, but, we have this enormous, asset bubble, primarily in equities, but there's no corresponding underpinning economy. It's like this huge disconnect like never before. But then it's, I've said this for several years now, but it's the economy, the stock market is now actually being used and promoted as evidence of this illusionary economy that everything is okay. There's no economic underpinning for what we have for this market.
We'll have more with Tim Wood right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Tim Wood. Tim, so is there any economic data that shows that while the stock market might be doing great, the things that the stock market is supposed to be indicating aren't doing so well?
Well, I covered a list of those last time, but besides these things with the debt and the diminishing return and the flat and inverting yield curve and on and on and on, turning back to my notes of what we talked about last time, to recap that data, I'm not seeing it, and if there is something somewhere, it's so overshadowed by all of this other data. But let me just go through the list, and these are facts. These are statistical facts. The economic growth rate has been contracting since February of 2015. The GDP growth rate peaked the second quarter of 2018. The CPI growth rate peaked in September 2011. The ISM Manufacturers Index, it's at the lowest level since 2009. The ISM employment numbers are contracting. The consumer credit is not expanding. Cumulatively, it's expanding. The growth rate has been contracting since November 2011. If credit is not expanding, the economy is not expanding, period. Domestic automotive output it has been contracting since January 2013. Well, if the economy is so good and people have so many jobs, why is the ISM numbers contracting? Why is it that automotive sales are down and have been for 6 years according to this data? Why is it that and to confirm the automotive sales output, the automotive output, you look at the sales, and I don't have those numbers in front of me. I didn't make that note, but if you look at the domestic sales, they're also down. Why is it the industrial production index peaked in August of 2010, and the growth rate, at last I looked a couple of weeks ago, was below zero? Yeah, here it is. Total vehicle sales peaked in August 2015. So that confirms the automotive output numbers. Why is it that the velocity of money has turned back down? Why is it that the yield curve is so flat that the difference between, and I looked at this last night, the difference between the 3-month and the 30-year is less than 0.5%. Why is it that the rail boxcar freight traffic is at the lowest level in 20 years? I mean, I can go on and on and on and on. But yes, we have this illusion that all is well, and we're being told that because of the stock market, we have this great economy. There's never been a greater disconnect. And I've said for years, we've been talking about this. I mean, it hasn't changed. I mean, some of this stuff I said has been going on, this disconnect, since 2011. This has been, statistically, the worst recovery since the Great Depression. But of course, we have this great stock market bubble. And I don't know, like I said, I don't know when exactly it's going to come to a head. We come to these intersections technically where things will, to set up to try to crack, and in my opinion, it's saved, and we see it. The last attempt with that was back in September when they came out with the non-QE, and then we'll get the tweets, and we'll get a China deal thing, we'll get something, and they'll keep the ball going, keep it going somehow, some way, with any means possible, and it's going to continue until those little tricks fail, and when they do, I think they fail miserably, and then all this underlying economic data at some point is going to matter, and it's going to matter a lot. And the reckoning, I mean, it has to become reality.
Tim, would you call this an invisible recession, where we've gone and gold gilded a rotten house where the foundation is crumbling, but if you look at it from the outside, it looks beautiful?
That is a good analogy. I don't think we're technically in recession yet. I wouldn't go that. I mean, yes and no. Yes, your analogy is spot on with the condition. It's a house of cards, basically, is what you're saying. Absolutely. Are we in recession yet? No. Looking at the numbers, no. I think that when we tip into recession, if that doesn't bust this thing wide open, I don't know what will. But I think we're teetering on that. And I think what we have been in, I think we were headed that way technically into recession back in, let's say, early summer, midsummer. I think we were headed that way hard. I think the can got kicked down the road again, and it put us in this little period, as a friend of mine described it, a period of tranquility. We saw interest rates kind of bottom. They popped a little bit. We saw this last rally in equities. We saw this last little rally in commodities. Of course, commodities are falling apart now. Obviously, they've rolled over, but looking back at the charts coming out of the summer, I'm talking about. And so I think we were in this little period of tranquility during that time. Now, I think we're in another one of these windows of opportunity where things are trying to roll. And once we roll and we tip into recession and we get a technical setup in the market, that is required to give us the structure where it can break, then I think we're going to be in a very, very dangerous position. And at some point, you could look at the facts. We've been talking about the bubble for as long as we've been talking, but it's true. I mean, it doesn't change the facts. I mean, the underlying data is what it is. These numbers are what they are. I mean, I just talked about the debt and diminishing return. That's been going on now for 10 years. And so, yes, it's beyond comprehension that it's lasted as long as it has. Doesn't change the fact that it is what it is. And so, all this while, the bubble has just gotten bigger and bigger and bigger and bigger. And eventually, like I said, one or two things are going to happen. Either control is going to be lost, and it's just going to go, or maybe they just kind of ease out and hope for the best and let it go. I don't know. But I point back to something I've always said. There is not one bubble in history that has ever survived. And there is no way this one is going to be an exception. Now, how big it gets, I don't know. Can they hold it into the next election? I don't know. But when we get the technical setup for it to crack, then I think all bets are off.
Tim, thank you so much for chatting with us.
Thank you.
My guest has been Tim Cyclesman Wood, editor of Cycles News and Views on cyclesman.com. If you have any questions for Tim or any of our other guests, you can send them to info@housestreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @Housestreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on Housestreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. Housestreet.com radio is a production of House Street Media Incorporated.